mute yourself when we're in this. So with that, I want to introduce Jim. So first of all, huge thanks to all of the different professionals in this town who are trying to help figure out the CARES Act. But in particular, Jim and Chambliss, you guys have really kind of stepped up to the plate, and appreciate you being willing to come and share what you know about this incredible piece of legislation and the changes that are happening. So a little bit of quick background on Jim. He is a shareholder at Chambliss here in town, and he is chair of their charitable and public purpose organization group. So he works day in and day out with nonprofits, foundations, healthcare organizations. That is his expertise and his client roster. So he is a natural choice for them when they have put together an internal COVID-19 task force at Chambliss. So he's co-chairing that, and is just really keeping an eye on everything coming out at all the different levels. And so he was a perfect person for us to ask to come and share his knowledge with this, because I know everyone has lots of questions. So I'm going to hand it over to Jim. He's going to run us through a presentation, and then we're also going to do Q&A at some point. But of course, if you have questions as we go, feel free to put them in the chat. So I'll stop talking. I'm going to let Jim take over.
Thank you, Abby. I appreciate that very much. Welcome, everybody. These are truly unprecedented times, and as a result, we're working through, as Abby mentioned, functioning with new technology, and I have learned a whole lot more about Zoom meeting than I ever thought I would. So hopefully you can bear with me as we scroll through the presentation. I think just from a housekeeping standpoint, to the extent that you have questions, as Abby mentioned, go ahead and place them in the chat. One of my colleagues will be scrolling through and watching the chat ribbon. And so to the extent that there are questions that we can identify and respond to, we will do our best. Of course, we may not get to all, but we will be choosing those throughout our presentation, and we'll allot time at the end to respond to as many as we can. So with that, we'll jump in and get started with the presentation. As everybody knows, of course, we're talking about what has been referred to as the CARES Act, and that's the Coronavirus Aid, Relief, and Economic Security Act. It is historic in that it is allotting $2.5 trillion in resources to the individuals, businesses, distressed larger businesses, healthcare industries in general. But our focus today will be on the Paycheck Protection Program that is being administered by the SBA. The good news, of course, for us is that these dollars are being made available for assistance to many businesses, and we're going to detail who those businesses are, how you apply for the loan, what level of loan you might get, what kind of loan features are applicable, and then at the end, hopefully, how you might earn forgiveness of the amount that you're able to secure. So, many of you probably saw today's report, which I'm going to mention, that 6.6 million Americans filed for unemployment this week. Truly astonishing numbers. And then more acutely to our issues, a recent blog article, Nonprofit Quarterly, which I've linked there, good read, lots of interesting data. It cites the fact that from among nonprofits it surveyed, half were feeling confident that they could meet payroll needs in the next 4 weeks. But then as you extended things out another 8 weeks, only 35% of those surveyed felt as confident. So pretty clearly with the changing economic times, there's significant concern among our nonprofit sector about basics such as meeting payroll concerns. So the solution, the payroll protection, the Paycheck Protection Program, as mentioned, it would allot $349 billion in total assistance to borrowers. The good news is what typically is available from the SBA is limited to for-profit enterprises, but under the Act, the eligible borrower has been expanded. It now includes nonprofits that are characterized or classified as either 501c3 charitable organizations or 501c19 veterans organizations, providing that they meet small business criteria relating to the number of employees maintained. Now, before we get to the employee count issue, I will mention briefly for those organizations that are not classified as C3s or C19s, this doesn't mean that you are precluded from any form of loan assistance. The Act also made available, it's currently available now, economic injury disaster loans that the SBA also administers. So to the extent that you represent an organization that might be a C4, 5, or 6 and are seeking assistance, I would encourage you to look at the economic injury disaster loan program. And those are administered by local SBA lenders. We'll highlight who some of those local lenders are in just a moment. So as I mentioned, and I skipped a slide ahead, I'm going to try not to get ahead of myself too much. But the key determination, of course, is that eligible nonprofits must not employ more than 500 employees. And when you're counting the employees, the SBA tells us that includes every employee. It does not, though, include volunteers. So when you're counting, you are including your full-time and your part-time staff, but excluding your volunteers. Now, I mention this here as just a caveat. In the event any of you work with or for charities that have linked arrangements, that is, supporting arrangements with another charitable organization, then you might, for purposes of accounting employees, be considered affiliated. And if affiliated, then of course the SBA would look at the aggregate number of employees involved to decide whether there was an eligibility issue or not. We can certainly get into more detail about affiliation and supporting organization issues, but generally speaking, if you want to learn a little bit about whether that might apply to you, typically a supporting organization is set up under Section 509A3 exclusively to support another charitable organization, which is a C3. So we'll move on and not get too far in the weeds with that information. And as part of the SBA program for paycheck protection, some more good news is that the Act really expands access to funds. Previously, borrowers under an SBA program were required to go through a pretty lengthy and detailed qualification process, demonstrating creditworthiness, also demonstrating that they could not, though, otherwise obtain reasonable credit elsewhere. Pretty exhaustive kind of application process. Now, through the Act, that process has been dramatically streamlined. So borrowers need not demonstrate any of those criteria. Instead, the borrower must demonstrate or certify that due to uncertainty caused by current economic conditions, a loan under the program is necessary, that they will use the proceeds for approved uses. And we're going to review in just a moment what those approved uses are. And they do not have pending another application for Paycheck Protection Loan Assistance. Now, you might remember I mentioned a moment ago the economic injury disaster loan. If that is something that a charity has already secured, that loan can be rolled into the Paycheck Protection Loan Assistance and refinanced that way. So that's good news too. So kind of hitting on each of the certification requirements to provide a little bit of background and depth there. What does it mean when you certify that there's uncertainty given current circumstances? Does that mean that if you're currently feeling pretty comfortable but very concerned projecting out for the next month or 8 weeks, that you meet the standard? As I've stated the question there, does the fact that you might miss payroll or you feel uncertain about whether you can make your payroll expense, does that qualify? And I'll tell you at this point, and you're going to hear this a few times throughout our presentation, we don't have guidance yet from the SBA about that. What does that really mean? I think what it means now is our legislators who enacted this legislation wanted to be sure that there was a broad, inclusive loan program. So I would tell you that to the extent that you work with your SBA lender and you're comfortable working with your lender about making the certification, and they are as well, I would not worry about this concern. I highlight it though because we will hear more from SBA in 30 days, and we'll find out more about whether there are any indications about whether uncertainty requires some level of factual awareness that we're not currently aware of now. So what are those approved uses that can be made of loan funds? Well, they include payroll costs. We're going to go over what payroll costs includes because it is very nuanced. Interest on mortgage payments. Now let me emphasize here, it is interest only, so not principal. Rent, utilities, and also interest on any other debt obligations as long as those were incurred before February 15. Now, one thing I'm going to point out here, and we'll come back around to this when we start talking about forgiveness and how it works, and that is that the scope of what an approved use of these loan funds would be is actually greater than the scope of uses for which you can receive forgiveness. And I know right now you're probably thinking, I'm not sure what that means, but I will tie that back up so that we can understand the difference between the two, but it's significant. So what are the loan features once you apply for and secure a loan? Very favorable, but the idea from the program is that you would obtain a loan up to 2.5 times the average monthly payroll costs, not to exceed 10 million. So remember our nonprofit quarterly article where it referenced the fact that so many of the nonprofits and of course other businesses are very concerned, not feeling comfortable about making payroll at least 8 weeks out. The idea under the program is to assure with the loan assistance that the payroll can be made and to provide a little additional assistance that can be then used for those approved purposes. That is about 25% of the total. So some of the other attractive features about the loan, as you can see, no collateral or guarantee may be required. Under the Act, we were told that interest rates could be as high as 4%. but the SBA has come out recently and indicated that they're going to apply consistent terms across the board, and that only interest at 0.5% will be charged. And that to the extent amounts are not forgiven, those will be subject to a 2-year maturity in payment. The loan payments, which is a wonderful feature, may be deferred a minimum of 6 months. And under the act, we were told initially, well, the SBA is going to come out and tell us how that's going to work. Well, the SBA didn't waste any time. They came out and said, look, we're automatically going to defer. Once you originate, we are going to defer payments, that's both principal and interest, for 6 months. So ideally, thinking this through, we're going to cover that last point there, that they may be forgiven after 8 weeks. If you're able at the end of an 8-week period to secure forgiveness, hopefully you would zero out any amount owing. But if you're not, you would still then be subject to the deferral for at least another 4 months before having to pay the interest and principal of any remaining amount. So really attractive features for the borrowers that are able to secure the loan funds. And let me address one thing here too before we move on. I think you'll hear a lot of different things, and some folks are suggesting there could be a, quote, run on the bank. And I'm not here to tell you not to quickly apply if that's what you would like to do as soon as possible. But I would suggest that $349 billion would not be something that could be depleted very quickly. So if you wanted, obviously, to take a measured and a cautious approach, that is probably, from a timing standpoint, going to be just fine too. Okay, so we mentioned this a moment ago, and this is really an important point. When we're applying for the loan, one of the approved, of course, uses that we're going to apply the monies to are payroll costs over an 8-week period. So what happens then is that the Act tells us, for purposes of applying the loan proceeds, and also in terms of calculating our payroll costs for purposes of an application, what's included and what isn't. And remember, I'm going to highlight here, when I'm using payroll costs, I'm referring to 2 different periods. And I'll make this a little clearer as we move along and distinguish between when you have the loan and when you're applying for the loan. Because when you're applying for the loan, you're going to be submitting evidence of payroll costs over a period of time, and that preceded the loan application, obviously. But when you're seeking forgiveness, you'll be showing evidence of payroll costs over the loan period of 8 weeks. So what do payroll costs include for employees? Salary, wage, and commission paid, payment for vacation, parental, family, medical, sick leave, paid group health and retirement benefits, that's the employer side of it, not the employee. Of course, excluded are salary or wages in excess of $100,000. And there's been some discussion about this. Some have read this and said, well, so that means that if I'm paying anybody, for example, a salary of $150,000, I can't count that $150,000 toward my payroll costs. And the answer to that is no, that is not correct. What you can't do is count the excess. So for that person, for example, and we're going to show this in an illustration in just a minute, you would simply include the $100,000 and exclude the additional $50,000. An interesting item that we're going to get to in when we talk about Forgiveness is the exclusion of FICA and federal income tax paid or withheld, but only during the covered period. I will highlight what that is. Also excluded is any paid leave under the Families First Coronavirus Response Act for which you would secure tax credits. That cannot be included either. And as you can see from the last item there that I've bulleted or mentioned, when we're applying for the loan, we're going to use a 12-month period to figure our payroll costs. And that 12-month period, at least for purposes of the Act, was stated specifically to be 12 months prior to the point of your application being submitted or accepted. The SBA has come out and said, no, that's way too complicated. What we're going to do to simplify things is we're going to take your calendar year 2019 data. Now, for those organizations that might not have been operation a full year in 2019, what they're going to do is take your data from January 1 of 20 through February 29 and annualize that and use that data. So one of the other questions that has become pretty hotly debated is, are expenditures to independent contractors included for an organization? Let's say that you hired a consultant and paid that consultant to do a plan, help with developing a fundraising plan. Are those expenses included as part of the payroll costs for which you can either use that to obtain loan funds or that you can use as approved costs in the forgiveness period? And it is an unsettled issue, I guess, is the best way to put it at this point. There are a couple different schools of thought. One is that the language of the Act permits payments to contractors because it is just like a payment to an employee, oftentimes for many businesses, a critical part of how their services are delivered. But others say, well, wait a second, that might allow for a double dip. And those commentators suggest that because independent contractors themselves may submit requests for loans, they envision that SBA would not at the same time allow an employer organization to claim expenses of the independent contractor as payroll costs, and also the independent contractor separately, because that would create the potential for a double dip. So clear, everybody? It can become very complicated, and I hope today we're gonna break it down in the end and try to simplify as much as possible. And I don't want us to get too lost in the weeds, but I want you to be aware so that you have as much information as possible at your disposal when you do talk to your lenders and understand how the process works, or at least the questions that you might want to ask. So the next thing is, how is it that we compute the maximum loan amount that's available when we're applying? And you can see I've listed the 2 steps there. Primarily what you're going to do is you're going to take your payroll costs, and as mentioned before, SBA has said we want 2019 data. So to the extent you have calendar year 2019 data, you will total all of your approved costs. And what you're likely going to do is subtotal for each employee, add that up to a total number, divide by 12, and then multiply that number by 2.5, and that will give you your maximum loan as long as it doesn't exceed $10 million. And I'm betting probably most folks out there, that's not going to be an issue. So how does that really work? Well, I'm hoping you can not squint too much as you try to read this example. I'm just going to go ahead and read through it to try to illustrate how you might go about doing this. So under the example provided, 10 employees, 9 of them earn under $100,000 in salary or wages. That would be employees A through I. A 10th, employee J, earns in excess of $100,000. And they're otherwise able to make the other certifications that we talked about to apply for the loan. So here's what the organization would do. For the 2019 calendar year, it would for each employee include, and we're going to go ahead and just review what those would be. Let's assume for employee A, wages of $65,000. When I say wages, I think those are grossed up, including the FICA and income taxes. Not withheld, not deducted there, because I'm going to go back for a moment and mention when we excluded FICA and income tax a moment ago, that was only for the covered period. Well, the covered period we'll address in a moment in more detail, but it relates to the loan period and not to 2019 data that you're submitting as part of an application. So you're going to use a simplified number, which is just the gross wages or salary. And then you're going to compute on top of that health, retirement, and here medical leave, as long as it's not, remember, FFCRA credit worthy for a tax rebate, and you'll total that amount. And finally, you'll do that for each of the 9, and then the 10th there, you can see we have a hypothetical employee earning $187,000 in salary. So what you would do there, given the limitation, is you would only use $100,000 in salary. So at the end of the day, and I can see we have a typo there. We have 111,000 use 124,000. I think what we meant was 124,000 use that number. But as you can see, the way you would get to 124,000 is you would cap the salary at 100,000, add 12 for health, that's 112, 7,000 for retirement, that would be 119, and then add 5,000 for the medical leave, and that would get you to 124,000. And then assuming that you would subtotal all of those up, you would then secure a number of, hypothetically, 848,000, which you would divide by 12, and that would net the number of 70,666.67. Taking that number, you multiply it by 2.5, and you'd secure your maximum loan there of $176,000 roughly. Now, many of you might be asking, is it really going to be necessary for me to try to crunch all these numbers? I would suggest to you that probably many of your lenders will be available to help walk you through how you would take your payroll data and compute the exact number to which you would be entitled. We're going to look at the form application in just a second, and I'll show where the applicant would write in or print in what it thinks it's entitled to. And of course, then it's up to the lender to really crunch the numbers and decide what it is the max loan could be. So here's the first page of the SBA loan application that was issued. And you'll see in the second box from the top, it says average monthly payroll, and it just has a total figure there. And then it includes the multiplication there, the product of 2.5 equals and a dollar amount. And again, I think there you're going to secure the assistance of your lender to help walk you through what documentation is needed, and then what numbers do you run to get your loan amount so that you will know the right amount to include, or they will include for you. Okay, so we've mentioned this a number of different times, but a key feature and really desired by a lot of potential lenders is the forgiveness part of the loans that are available. And what we're told by the Act is that forgiveness is available for payments made over the 8-week period following the funding of your loan for payroll costs, interest on mortgage, rent, and utility obligations, provided those were incurred before February 15, if you maintain your employee FTE and payment levels. We'll talk in a moment about specifically what those are and how that works. So one interesting thing I want to point out here, because I think I mentioned this at the top of the presentation, when you're talking about forgiveness, I think there might be this idea that it's, walk in the park. You go, you get the money. It's, certainly cheap at a 0.5 interest rate, even in the worst case. And oh, by the way, we'll just get it all forgiven anyway. Well, that may still be possible, but there is some nuance and some detail about how that might work. I'm going to try to walk you through that again. So when you apply and when you talk to your lender, you will be knowledgeable and can then ask questions of them about how they'll help you with that process. So one thing that's interesting to point out is when we originally talked about approved uses of the funds, I mentioned at that time that they're actually broader in scope than the expenses you can pay with the loan proceeds for which you can get forgiveness. Again, the Act tells us you can get forgiveness if you pay these sums. One of the items that I'll highlight that was included as an approved use, but is not included as a forgiven expense, is this payment of other debt or interest on that debt. Remember that one of the items is a payment of interest on a mortgage. And I failed to mention earlier, let me mention now, a mortgage, when we think of mortgages, of course, we think of the interest that banks hold on our homes. So we think about real property. But these mortgages, for the purposes of this Act, include not only interest in the land that the lender, that your creditor would maintain, but also interest in personal property. So for example, if your bank had previously extended to you, let's say in 2018, a line of credit, and they took a security interest in your furniture, fixtures, and equipment, that loan would be deemed a mortgage. And so a forgivable and approved use would be to pay interest on that debt. Now, another form of other debt that would not be considered a mortgage, by contrast, is, let's take that same line of credit that was made available in 2018. If that wasn't secured by an interest in your furniture, fixtures, and equipment, it was just obtained on a signature, then that would be what's qualified as other debt. And payment of interest on that other debt, while an approved use, would not qualify for forgiveness. One of the other things, and again, highlighting this from our earlier discussion, is what about FICA and income taxes when we're using loan proceeds to pay payroll costs? Remember, I mentioned that those arguably are grossed up when included in the application, because excluded term payroll, taxes applies only to the covered period. And the covered period would be, again, the 8-week period following the funding of your loan. So the converse of that, of course, though, is if you take the loan proceeds obtained and pay payroll costs, to the extent those are used to cover the employer's share of FICA and income tax, then those would be excluded potentially from the payroll cost forgiveness computation. So how does all that work? We're gonna go into some more detail once I finish talking about other reductions. But again, I want to emphasize here that I know this is very technical, and there's a lot of detail with it. But again, these are questions when you seek loan assistance that you should be talking to your lender about. How does the forgiveness process work? Don't want to get caught in a situation where you're taking the loan and then maybe incurring indebtedness that you otherwise had not planned for because you weren't able to gain forgiveness of all the loan. Better to be prepared for what that might look like, or what circumstances might cause that. So some other circumstances that you need to consider here are the forgiveness reductions that apply under the Act. You've heard, well, what is required is that we simply have to maintain our employee headcount and their pay. And that's essentially correct. But of course, under any program like this, we can't keep it that simple. We've got to make it much more complicated. So I'm going to walk you through briefly what those reductions look like and how they might work. And then we'll wrap up with questions that I know my colleague has been forwarding my way, and I'll do my best to get to those in a moment. But back to the reductions. So the first reduction applicable is if you reduce your FTE count greater than 20, or excuse me, if you reduce your FTE count during the loan covered period, that's the 8-week period, compared against one of two periods, then you may receive a reduction in a proportional amount. And I'll show you how that works. The other is if you reduce significantly the pay of any of your employees who make $100,000 or less in compensation or wages, then you would receive a dollar-for-dollar reduction for the amount of that salary or wage reduction to the employee. But as I indicate here, you can rescue yourself if you restore those FTE cuts or pay cuts before June 30. So how does that work? So here is a rough example. I hope you all can read and work through. And by the way, as was mentioned earlier, this is going to be recorded and available. So and if you'd like copies of the slides, I can certainly work with Abby and Ada to make that available as well, so you can look through these examples in greater detail and at your leisure. But working through the example here, the assumption is kind of based on a prior example that the charity borrowed $176,000 on April 1. And over the 8-week period that followed, you can see that it spent those loan proceeds on a few of the items listed there. I'm going to highlight for you the last bulleted point there, the expenditure on an interest on unsecured line of credit that was obtained February 1st, before all of this assistance was known really to be available. So what then are the potential reductions that apply there. Well, we highlighted that a moment ago. If you're adding that up, as we know, payment of interest on other debts, like the last bulleted point, would not be included. So if you take the total figure of 176,000 and change, that would be reduced by that amount so that you would net a forgiveness figure of 166,000 after computing or deducting the amount paid on the other indebtedness. Also potentially applicable, you have the reductions that I mentioned just a moment ago. So let's say that O was forced to take a reduction in workforce. There were 3 part-time employees that were laid off, and O reduced the pay of employee A from 80,000 to 70,000. Employee B, 60,000 to 40,000, employee C, 40,000 to 30,000. What's the result of all of that? Well, let's start with the first part. And this all occurred, by the way, April 15. So 15 days into the loan assistance that was provided. So where for the reduction of FTEs, this is how the calculation would work. The borrower would calculate the actual number of, the average, I should say, FTE count for the 8-week period, the 2 months involved. So in this case, you'd figure an FTE count for April and one for May. And as I mentioned here, because our hypothetical states that the FTE count in May was 9 and 10 in April, that would net to an amount 9.5. And when you compare that to one of 2 time periods, as I've got mentioned here, either the quarter before the loan period began or the period that was February 15 of 19 through June 30 of 19, you're figuring average FTEs and you're taking the proportional amount there. And in our hypothetical, it would be 9.5 over 10, so that you would have 95% roughly of FTEs by average, so that you would incur there a 5% reduction. And again, I know this is technical and there's a lot of detail with it. So again, I want you to be aware generally of how this works, so you can work with your lender about these very calculations and help get help walking through them. The other hypothetical reduction is where we've got, of course, a 25% reduction in wages or salary for an employee. And in our hypo, we really only have one situation where that would apply, and that's employee B. Employee B, as you can see, was reduced from 60 to 40,000 annualized. So the amount of that reduction is roughly 33%. And so what you would do is take dollar for dollar, remember, because it exceeds our 25% threshold, the amount of the reduction, and apply that as a reduction also. Now, interesting question here for your lender, which is, does that mean that you're taking an annualized amount, because we're talking annualized amounts here, the 60,000 and the 40,000, and the annualized reduction is 20,000, or are you prorating that to the 8-week loan period, which would be something, of course, much more modest, about $3,300. That's to be determined. We'll see where that one works out. But using the hypothetical where we use a proportionate and then prorated reduction, that would reduce our figure further to 154,000 and change. Now, all of that is to say you can rescue yourself. Assume that all of those factors occurred, but you said, now that we have a loan assistance and we've adjusted our workforce and we're beginning to come back online here in June, and we're facing volumes and demands for our services that are picking up, and we're bringing everybody back, and we're restoring the FTE count, let's say to 10, and we're restoring the pay of our employees to their previous levels, then all is forgiven, meaning there are no reductions. In that case, we will be back to the amount eligible of $166,000. So, tricky, I know, and a lot of detail with that, but I wanted to make sure that we walk through all of the relevant parts of the Act and gave you a lot of background, maybe too much background and technical information, but again, so that you can be educated about the program. I'm going to look at what some of the questions are now and see if I can address those. If you'll bear with me while I look through my text messages where we've queued these up. Okay, so one of the questions is, are you aware of a restriction on religious-based organizations? As a faith-based school affiliated with a church, would we need to consider church employees? We are technically separate entities, but in the same building. So first off, there aren't any restrictions against religious-based organizations as long as you qualify as a C3. Now, most churches, not all, but many churches, I guess I should say, are exempt without having to qualify as a C3. Some churches have elected to qualify as a C3. Now, as well, if you're operating a school as a separate entity that is itself qualified as a C3, then I would tell you that you are appropriately qualified as a nonprofit organization under the Act. Now, the rest of the question would be, is there some sort of aggregation of employees? Is there common control? And that really comes down to, does the church, through its board or organization, appoint the board of your organization? Does it otherwise control the operation of that entity? If the answer is that they are independently operated, even though they might share staff or services and those kind of things, the issue is there a sufficient amount of control in the church such that they would be aggregated? And I would tell you, in the absence of that kind of control, the answer would be that there would be no aggregation. But if you need help with that question, of course, my contact information is at the bottom of the slide, and I would encourage you, we'd be happy to help you address that question. Okay, another question, are contractors, those with 1099s, counted as employees? As we addressed earlier, that is an interesting question for now. There are two schools of thought on it. One school of thought is that, yes, the Act by its language allows an organization to include those that it pays and then provides a 1099 to count as a payroll cost. There's another school of thought, which is that no, independent contractors must separately apply for their own loan if they're going to. Where's the resolution of that going to be? We don't know yet, but we hope that the SBA, which is supposed to come out with guidance 30 days after the Act was passed March 27th, so we're hoping by April 26th, that there's guidance on that issue and we have greater clarity. So great question though. Let's see. Here's another questions relating to payroll costs. Payroll costs, are all employee wages included or only full-time employees? All employees are included, not just full-time. When calculating payroll costs, does health insurance include both health and dental? Yes, it does. Okay. it says, on the application for number of jobs, what date should we use? Our business is somewhat seasonal. That is a great question. The Act does provide some guidance about the period that you use, and that would be January 1 of 20 through February 29, generally speaking. But there's a detailed formula. I'll punt a bit here and say that's one you need to talk with your lender about to be sure that you're getting the right data there. A quick word, by the way, about lenders at this point. Many of our local institutions are SBA preferred lenders. I'll throw out a few examples. Truist, which of course used to be SunTrust Bank, Synovus, Smart Bank, and many others are preferred lenders. And if you visit their websites, many of them either have portals or web pages that are dedicated to the CARES Act Paycheck Protection Program assistance. Great resource centers for you. And of course, many of them allow you either to submit information or to ask questions, or at least contact somebody who can help you answer your questions. So I would encourage you, to the extent that you have more questions and I don't address them here, that you seek those out. And I would mention too that according to the SBA, at least, the loans will begin processing April 3rd. Now, I'm not sure if that means that lenders are or are not. I think they are taking applications at this point. It may be that there will be a period, though, that they will not begin the actual official action on those until April 3. And they have 15 days after your application to tell you whether you're going to secure a loan or not. Okay, let's see. If an employee chooses to leave, is that a reduction of our FTE? And does the amount of leave time an employee chooses to take affect the 25% reduction? Well, those are great questions. If an employee chooses to leave, yes, unfortunately, it does. Now, remember, you have a savings clause there. So if you hire someone in their place by June 30, so that your FTE count is maintained, then your reduction would be eliminated. So while the answer is yes, that person leaving would count against the FTE count, you can save the reduction that would otherwise apply by hiring someone in their stead in a full-time equivalent position. Let's see. Okay, here's a question I think is a good one for many of you out there. What is the difference between paycheck protection versus disaster relief through the SBA? We did touch on that very briefly at the beginning, so a little more detail about that. A disaster relief loan provides overlapping and similar benefits. But one of the key points to this is that it has only been funded up to roughly $10 billion. I think the actual figure is somewhere closer to 7. So as compared to 394 billion. So you have a pretty significant difference in pooled resources available under that program. However, it is available, as I mentioned earlier, to charities that are not, or I should say nonprofits that are not qualified as 501c3s or veteran organizations under C19. So it's got a broader scope. You can use the assistance under the emergency loan for broader purposes. They include working capital, supply chain interruptions, and other expenses that you might have. Now, one thing that you can't do if you're able to secure both the EIDL and the paycheck protection loan is you can't duplicate purposes. In other words, you can't use both to cover payroll expenses. Only the paycheck part of that can be used for that purpose. The EIDL loan is a little bit more nuanced in terms of application process. They've eased those burdens as well, but there may be a guarantee or a collateral that has to be furnished over a certain loan amount, and I think that loan amount is $200,000. They do not specify for the lender in advance some sort of formula by which you determine what your loan max would be. So that's something you would have to discuss with your SBA lender. You know, what might I qualify for? One attractive feature, if you need immediate assistance, is that under the EIDL, they will actually forward to you $10,000, which you can use, and it is excused from repayment, even if your loan application for the EIDL is ultimately refused. So that's a very attractive feature of that. Let's see. Going to get a few more here. Okay, someone asks about FICA portion of forgiveness. Will FICA and Medicare taxes be forgiven along with salary of the taxes for the 8-week period? That is a pretty complex issue, as I touched upon earlier. Here's the way I think the government is looking at it. They're not going to lend you monies to pay your taxes for which you can then seek forgiveness, if that makes sense. So the other costs that you incur, you may use loan proceeds during the 8-week loan period and secure forgiveness with, but you may not seek forgiveness for the FICA and income tax portions of the wages or salaries paid, because then you would essentially be getting a loan from the government to turn around and then have forgiven by the government, if that makes sense. So that's, I think, what the government is trying to get at. But again, we hope that there's greater clarity, that what happens is that the SBA will issue further guidance and will tell us maybe a little bit more about that, so that on the forgiveness side, there's more detail about what is and what isn't included, so that when forgiveness is provided, we know what we can plan for. Now, let me mention here too quickly, I want to highlight, because I don't think I did a moment ago. Let's assume that you went through that same hypothetical that we did a moment ago. And so therefore, you were left with an amount that is owing. So what does that mean? Well, the SBA has told us, remember, that that will begin bearing interest at 0.5% per annum. And you'll essentially be obligated by note to pay that amount back in 2 years. Now, the payments, of course, as we mentioned a moment ago, would be deferred. Those SBA has said those will be deferred right out of the gate 6 months. So that, again, using our hypothetical, if you secured your loan on April 1, then the payments would not begin, even on that balance that wasn't forgiven, until October 1. And then from October 1 forward through the end of a 2-year term, you would be obligated to pay the balance, presumably here a fairly modest balance, certainly with a very favorable interest rate. So I wanted to highlight that. Okay, a few more here, and all right. Once a loan is made, what documentation would we be required to provide to determine what is forgivable or not? Excellent question. Meant to highlight this and didn't do it, so thank you for that question. What the government has told us is they want your payroll records. If you have them, your 941s, They want receipts and canceled checks and other documentation. What I would suggest to you, and I think this was a really good suggestion in an article that I saw over the weekend, is that if you secure a loan, you might want to deposit the monies into a separate account. I realize many of you probably have payroll vendors, and that may complicate some things with your vendor, but it would allow you on the tail end when you're seeking forgiveness to track very easily the dollars that come out of that account that, of course, that are solely paycheck protection funds. And then as you go and you pay your expenses, when you're paying a mortgage expense, for example, be sure that you have either a canceled check, if that's possible, or if you pay electronically, that there's some other evidence of payment that you can use to show as a receipt to build your case of amounts paid that are properly, that should be properly forgiven. So very good question. Okay, next question. How do you count the FTE, monthly or just at the end of the period? Great question. That question again relates to the forgiveness period. Remember, that is the 8-week period that follows the loan funding. Let's assume again April 1. You're calculating an average monthly FTE count. So in my hypothetical, you would be counting your average FTE for April and for May, and then averaging over that period. And that's the basis upon which you would figure your average FTE for the loan period compared against the others. So great question. Hope that addresses it for you. All right, question is, would Teladoc be considered a health benefit? I believe it would. It includes, it's pretty expansive language of the act, which includes health insurance premiums and other health benefits. So I do believe that would apply if that's a benefit you're furnishing and paying for on behalf of the employee. Okay, it says, can or should you apply for both an SBA disaster loan and a paycheck protection? The answer is you can. You cannot apply for both for the same purpose. And this is something you actually certify in your paycheck protection. But if you're going to use disaster loan proceeds for other operating expenses, that's entirely appropriate. And in fact, as I mentioned, what your lender may choose to do is simply roll that economic injury disaster loan into the amount of your paycheck protection for one single loan amount. Now, on that score, remember that for your economic injury loan, you're not then at the end of the paycheck protection loan period, the eight-week period, you're going to get forgiveness of the economic injury loan amount. That's a different loan, even if lumped in. So remember, it's only the sum of costs spent on payroll and approved costs like rent, mortgages, and utilities. So that's the one caveat I would mention there. Okay. What is the date used to maintain FTE count? Okay, what they're looking at is, remember, they're comparing periods. So if you have someone leave March 1, you secure the loan April 1, they're looking at what your FTE count is during the loan period, which again would be April 1 through May 30, as compared against one of two periods. The first period is, what was your FTE count January 1 of 20 through February 29 of 20, or the period that is June 15 of 19, excuse me, February 15 of 19 through June 30 of 19. And what you're doing there is you obviously would want to pick the FTE count from the prior period that's most favorable to you as a ratio. Again, that gets very technical. And so I think you want to have that discussion with your lender and walk through hypotheticals so that you know how it works. And you're ready at the end of your 8-week period then to know what is likely to be forgiven and to build your case and advocate. Okay, a few more here, just come in. And let me get to my text here. Okay. What additional information forms are needed to apply in addition to the application? Good question. Again, they're going to want to look at the biggest thing here, of course, is payroll records. So when you're presenting your 941s or your other evidence of payroll expenditures, I don't know if you have QuickBooks or what, but that's what you're going to want to present to your lender. And I think that's part of the discussion when you're, maybe when you're gaining access to the websites today of our SBA preferred lenders, you want to have that very specific discussion with them. But the Act does reflect that those lenders are going to be looking through those kind of records to determine your average payroll cost. Now, as I mentioned, the period they're looking at is, if you were in existence for that period, of calendar year 2019. So those are the records that you want to gather up and have available when you apply. And I'm not sure how they're doing that. Through the portal, it may be that you're just simply scanning the records and then submitting those along with your application electronically. Or maybe they're requiring a hard copy. I'm not sure. You'll have to check about how that process works. Okay, next question. Do you have to apply at the bank you have an account with? No, you don't. I would suggest to you it might not be a bad idea if you have a banking relationship already with a lender. They're lending folks. That might streamline things for you, and you might also have access to someone who can answer your questions. But if you shop around, and I'll suggest to you at this point, even though the SBA has told us that there ought to be these cookie cutter loan terms, from our quick run through of websites, it appears that some of the application forms from our lenders differ in some respects. And some even differ on the issue of, does an independent contractor expense qualify or not as a payroll cost? As I mentioned, there are a lot of different schools of thought on that, but that's a question to have or discussion to have with your lender. One thing I'll mention here real quickly that I think is an interesting feature of the program is SBA has pretty much said, we're delegating to the lenders the authority to process these loans. And in fact, we're going to give them immunity. So we're not, in Washington, D.C. or in our local office, going to be breathing down the necks of our lenders to, audit what they do and ding them and hold them accountable if we disagree with their determinations about forgiveness or loan amounts. I think that's a real positive element of this. So as you're working with your lender and you're wanting to find out from them, what is the appropriate maximum amount or what is the max forgiveness I can get, you can really trust the guidance that you're getting will be binding. Now, when you have those discussions, of course, if they're informal, you might want to put something in writing so that you can go back to it if you need to it. But I think that is a wonderful feature of the program, is that you have that localized decision making that's enabled. Okay. So a few more. Let's see, we do have a few minutes left. it says, who needs to apply for the loan, our CEO or board? Well, your board can authorize certainly your CEO to apply for indebtedness. And I would, I'm going to use a typical lawyer response here, which is it might depend in part what your bylaws or your charter provide. So I would start there. But then what you're probably going to want to do is have some level of authority from your board, unless that's already available through a prior resolution of your board. You're probably going to want your CEO to be authorized to secure the indebtedness. So I would recommend that you do that. All right, let's see what other questions we have. And bear with me a minute. Okay. Any guidance about the ownership section of the application for nonprofits? Who should be signing the certification for nonprofit? That's kind of similar to the question we just addressed. You know, of course, there aren't owners of nonprofits, but there are authorized officers. So as mentioned a moment ago, that's really the route that you would want to go, is you would want your unless otherwise previously authorized, you want your board probably here to approve the CEO or executive director to sign for and apply for the loan obligation. So see if there are any others here that are queued up. Okay, I think we've run through a number of these questions. I might not have gotten to all of them, but we're also pretty close. Let's see, it's 12:48, so we might end here early. Don't know if Abby or Ada, you want to say anything in closing?
Well, first of all, thank you, Jim. That was an incredible amount of information. So
You're welcome.
thank you for all your time and effort. A couple of housekeeping notes. We will be sending the slides and the link to this out afterwards. And just want to do one final plug that if you guys want to become members of Venture Forward for free for the next 3 months, please do that. We are, as I said, really building out lots of different things for you guys to help build capacity and help us all get through this together. So we just so greatly appreciate all the work that all of you are doing, both on the front lines and and also organizations that are just trying to adapt to the current situation and figure out what the future holds. So thank you. And we will, I think we'll adjourn now.
Thank you, everybody.
Thank you, Jim.
Thanks, Jim.